Hi, everyone. We're very excited to have Sterling Fairholm of Reliance Insurance Brokers with us today to talk about some of the questions that I've been hearing a lot, which is what happens if you have to file a claim with California Fair Plan, or what happens if Fair Plan runs out of money. So, Sterling, guide us on this, please.
Sure. Well, obviously the first thing when it comes to the fair plan or any claim is to figure out what it is that we're trying to cover. Because the fair plan only covers a portion of your home and the DIC wraparound policy covers the other portion, I think what I tend to say is you don't really need to know what's covered where when you have this program. You kind of just need to be able to call when something happens and find out what should I do. And that's generally my recommendation, is to reach out to the agent and ask, this is what happened, what should I do? And that's where we're going to find out, is this going to go to the California Fair Plan or is this going to go to our DIC? And it gets really interesting when you start to get into trees and snow, because the way something happens will change where things are covered. So as far as what do you do when something happens, my first suggestion is to call the agency and try to tell them what happened. But filing a claim will be the same as filing a claim with any company with the Fair Plan. It's an online form or a phone call where you are purely just stating what happened and giving policy number and so on. And the good thing is to make sure that it should be going to the Fair Plan. So a fire, obviously, smoke, wind, vandalism, which are the main coverages on the Fair Plan. Everything else is going to go to the DIC.
So, DIC stands for?
Difference in conditions, which means it's a regular home policy that changes the conditions of the policy to exclude smoke, lightning, wind, vandalism, and fire. So essentially, all the things that are covered by the Fair Plan. So a DIC is a regular home policy with all the normal things, but it excludes the items that are covered on the Fair Plan.
Okay. And then, so in case someone needs to file a claim, they call the agent, and then the agent will tell them whether they should submit a claim to the Fair Plan or to the DIC coverage carrier.
Absolutely, because it does depend. If there's a burglary, it's not going to be the Fair Plan. It's going to be the DIC. If there's a broken water pipe, that's going to be the Fair Plan. If a fire happens in the kitchen, that's the Fair Plan. And so you do want to make sure you're filing the claim at one place. Very rarely have I seen claims go to both. It usually involves something falling on the house, snow, weight of snow, or a tree, because at that point it gets a little questionable on what caused it. Was it a windstorm? Did a wind blow a tree down on the house, or did the tree fall due to the weight of the snow? And so we're going to have to get the two carriers to kind of fight that out at that point. But that's generally the only time I would ever file it with both, when there's a little bit of a gray area with wind and weight of snow.
Okay, so what happens if the insurance coverage is not enough to rebuild and you still have a loan?
Sure. So that is definitely one of the big problems, is the way that inflation has gone and the cost of building goods and materials have skyrocketed. Labor's skyrocketed. I mean, anyone who's tried to get a bid to replace their floors are usually shocked at the numbers, and all that plays a role in rebuilding a home. It is easier to rebuild a home from scratch than it is to remodel a home. So I sometimes have the conversation where someone says, well, I just spent X remodeling the kitchen and the bathrooms, so rebuilding my house must be astronomical. And that's not always the case, because you don't need to earmark the same amount of money when you're building from scratch for a kitchen, because everything's already set perfectly ready for that kitchen to go in, those cabinets and everything. You have this empty vacant shell that you're building. So the numbers to rebuild are generally not based on remodel pricing. So you want to kind of separate that. But it does happen that most people think that it is not as much to rebuild as it really is. It is always more than you think to rebuild. Contractors throw numbers out there that are dependent on their current workload and their workflow. So it's always good to get multiple bids. But let's say that you're in a situation you don't have enough to rebuild. Fortunately, at that point, you have to decide what areas you're willing to cut, as well as what you're rebuilding. I've had many conversations with someone with a 4,500 square foot home that we're talking about this number, and they say, I would never rebuild 4,500 square feet anyways, and so that's something they're taking into account when looking at these numbers. But it's also important to not underinsure, because most policies have a co-insurance clause of 80%, meaning that your extended replacement won't kick in if you have undervalued your property more than 80%.
Okay. So then let's assume that you it, it your coverage is not enough to rebuild and there's a lender involved and lender wants to be paid back. Well, lender is worried about the lack of a structure of the collateral. What happens?
Yeah, lenders are going to be the first ones paid in these situations. So if it is someone that's taking a buyout, meaning they're not going to rebuild, and they just want a cash takeaway, they own the lot still, they have to clear the land, debris removal, the lender's going to take theirs first, and that's usually the loan amount. They're called the loss payee, meaning they're the first one to get paid. So if the loan amount is not, if the coverage is insufficient, they're going to get, however, all of the money for the most part, and then they'll foreclose on the land because now the land has value. So you still owe the money that you're on the loan for. So that, that brings up all kinds of other things like bankruptcy or just going after your assets. But generally speaking, the lenders have enough on a policy to make sure that their loan's covered. They don't care if you can rebuild. All they care about is the loan. So the rebuilding and making sure that you can rebuild usually comes down to your preferences and your risk tolerance to making sure that you have enough, because the lender's going to get paid regardless.
Yeah, it's a difficult conversation, I can imagine.
Yeah, I mean, we have the conversation a lot where we're talking about how the walking away from a claim happens, because some people, emotionally and time and effort don't want to go through the rebuild process. So that conversation comes up of what if, how would this work? And you will never come out ahead in that format as well as you would with getting a brand new house. And that is because the buyout number is generally probably going to look not as attractive as what the value of a brand new house is. The process of getting there, of going through and rebuilding is a bit agonizing.
Yeah. So let's say someone does decide to rebuild to a smaller house. Does the insurance company release the funds directly to the contractor? Does the insurance company release the funds to the lender? How does that work?
Yeah, all money goes to the loss payee. So the loss payee, being the lender, is going to dictate all of the money movement. So they will usually have a schedule. There's contractors that build homes will have a timeline when funds are released. So the insurance company is releasing funds to the lender. The lender then in turn releases funds to the insured, typically to pay the contractor. Not typically straight to the contractor, but it does depend on the lender at that point. That is one of the things that I hear can complicate things quite a bit. You may have heard lot of going on with trusts, people talking about my home's owned in a trust and the lender doesn't know, or the insurance company doesn't have the trust listed. So when we're starting to go through a claims process, one of the parts with the trust, it gets complicated when it's not a living trust. It's a trust that maybe your parents set up and the house is owned by the trust and that was passed down to the children. It gets a little tricky at that point because releasing funds and who it's made out to gets a little complicated, and people tend to get pretty frustrated at how slow that process can go as far as how money is released. And then, we're dealing with a bank at that point, and that bank is holding the money and they have to release it, and it can get a little irritating, but it is the process.
But otherwise, married couple with a property or a home in their living trust and their property insurance in their own name, that should not be a problem, right?
There's a lot of articles and scary things that were kind of out in the news about, oh boy, you got to make sure your trust is added to your insurance or you're going to not have coverage. That's not the case. The living trust has not really meant to do anything except pass money along in inheritance and to get away from probate. When you're a living trust, you are the trustees of the trust. So it doesn't really matter in any way whether or not the money is going to the living trust or to you as a named insured. Where it gets complicated is when those living trusts are no longer living trusts and they have been passed down. We heard some stories about now the home isn't even owner occupied, it's a rental property. So that's where things get a little complicated, is when what everybody thinks the property is no longer what the property is, and it's no longer owned by the right entity, insured improperly. So having your house in a trust and is not going to make the process of filing and working through a lender claim difficult. How you insure the property, the way it's utilized, meaning it's a primary home and I live in it, or it's a rental property and I rent it out. Another one is short-term rentals, Airbnbs, which is kind of a new thing. Insurance doesn't adapt very quickly. You'd want to make sure that it's insured for that use.
Yeah, sounds good. Okay, then another question I get a lot is what happens if California Fair Plan runs out of money? So I
Sure.
direct them all to you, Sterling.
Yeah. Yeah, sure. So I mean, it's a great question, but more so what I would ask is in general, what happens when an insurance company runs out of money? Because the Fair Plan did just run out of money. It happened during the Palisades fire. Palisades was heavily insured by the Fair Plan. At last number, I think it was 1.1 billion in a shortage. And the Fair Plan is backed by California. And in specifically, it's backed by the current insurance carriers writing in California. So this is actually one of the reasons why companies like State Farm, who has a very large market share, they have been trying to reduce their market share because when there's a $1.1 billion deficit between what their assets and insurance are versus what the claims, the insurance companies are on the hook for that money. State Farm would have to write a $300 million check to the California Fair Plan because they have a 30% market share. Travelers will have to write a $100 million check and so on and so forth. And this happened. I mean, it's documented and out there. We watched this happen. And I don't want to say it happened seamlessly, but insurance companies know in order to write in California, you are aware that you are next stop for the California Fair Plan. So which is why there's very little risk financially in going with the Fair Plan because it is an admitted market. It is backed financially. So they don't run out of money because they just send a bill to the other insurance companies. And that is the case for all admitted companies, except all admitted companies are backed by the state. So a admitted carrier versus a non-admitted carrier we've talked about in the past, but the reason that an admitted market is so much far superior from a safety blanket standpoint is the fact that if we see an admitted carrier go under, not have enough money to pay out claims, the state takes over the process and they have a designated fund to handle this. We did see this happen in the Paradise fires a number of years ago, where a couple very small companies did become insolvent and did have to get taken over by the state to pay out claims. So the Fair Plan and the admitted markets have a backstop to protect you beyond reinsurance and other items, whereas non-admitted does not.
Okay, so what happens if the non-admitted runs out of money?
Technically, then you are going to get the portion of money that they have. So if they are 30% short on the entire claims, you're probably going to be 30% short on your coverage, which is why it's really important to pay attention to the non-admitted carriers rating because they do have financial ratings. Also to what exposure that company has. And most companies are very good about limiting the amount of exposure they have. There are lots of non-admitted companies that there's certain zip codes you can still do and certain zip codes you can't. And you can't do those zip codes because they already have enough insurance in that area. They can't risk having an entire neighborhood on the books and that neighborhood wiping them out. So generally, insurance companies are very diligent about overexposure and they are required to by their reinsurance. So they're going to make sure the insurance companies that they buy insurance from are going to make sure that they're not overexposed at any area.
Thank you, Sterling, for making us smarter about property insurance. It's a very complicated topic right now.
It is. I appreciate it, Elsie.
Well, if you have any questions about property insurance in California, please reach out directly to Sterling Fairholm at Reliance Insurance Brokers. His contact information is on the screen. And if you have questions about property, mortgages, and real estate investing, reach out to us at Abundance 99. Thank you, everyone.